So the first column there is, if you've got a basic income of 50,000 taxable, you've got your personal allowance, so there's no tax on the first slice. The next bracket is 20%. You've got 7.5, 7,486, and then 3,639 of class 4 national insurance. So essentially, on income, taxable income of 50,000, your total tax and national insurance will come in at 11,125. So on there. So the blended tax rate is 22%. Looking at the next column, we've got a tick up in income by £25,000 there. So again, if your taxable income is 75,000, you've still got your personal allowance. You're going into the 40% tax bracket, so you've got some higher rate tax to pay there at 9892. Class 4 insurance kicks in. So your total tax and national insurance liability comes in at 21,590. Again, the blended rate, because you've kicked in to the 40% at a higher rate, comes in at 42%. Similar picture at 100,000. And you'll see that we've got some red boxes appearing just above the £100,000 mark. And what that illustrates is when you start getting above £100,000 worth of income, if you look at the bottom here, your effective tax rate for income between 100,000 and 125,000 goes to a whopping 62%. And the reason for that is, you lose your personal allowance because you've gone over £100,000 of income. And effectively, you're paying 40% tax on personal allowance plus 40% on the extra 25,000. So it does get quite punitive when you're in this little twilight zone here between 100 and 125. So if you're up to date with your current year income and you know that you're going to land somewhere between this, I would be looking at ways of trying to mitigate it. So bringing any costs forward, looking at private pensions, whatever you can do to try and bring that down. Looking training courses or whatever. These are the kind of things that we need to be looking at. And then when you get to the £160,000 level, again, another red flag, which is the 45% tax bracket. So again, the effective rate for £160,000 is 44%. Now,
Vali, sorry, you mentioned training courses, which is quite a good one because a lot of dentists aren't sure about whether they can put all training courses through and get tax relief on, or whether it's limited to developing their current skill.
So yeah, if it's an existing skill set, then it's tax deductible for both sole traders and limited companies. If it's a kind of a vocational or a more specialist course, which is adding a different skill set, then as a sole trader, you won't get a tax relief for that. But as a limited company, you will. So that's a question we get asked often.
Yeah, thanks.
Okay, so bearing in mind the landscape of the tax rates for the next 4 or 5 years, we could see that this is what the tax position is going to look like, without dividends, and if you were earning a salary. This is effectively what the tax landscape is going to look like. There are some increases in taxes and national insurance coming up, and that will particularly affect those dentists who are operating as limited companies. Now, most limited company owners, operators will generally take a lower salary and higher dividends. But we just need to start thinking now about how we structure drawings from the business, because there's a increase in tax on dividends by 1.25%, and that kicks in on the 5th of April 22. So you've got about up to £50,000 in the basic rate tax bracket. we're used to paying 7.5%. That'll go up to 8.75. Up to 150,000, it's 32.5%. That'll go up to 33.75. And then the additional rate where you've got taxable income over 150, it's 38.1%, going up to 39.35%. That then goes hand in hand with the increase in national insurance rates, which again is going to kick in the 6th of April this year. Again, there's another 1.25%. Now, what the Chancellor said is this is a temporary increase, which it is, because it only runs as an increase in national insurance from the 6th of April 22 through to the 5th of April 23. But after that, we'll still be paying an extra 1.25%, but it will have a change of name. It'll be called the social care levy. So that extra 1.25% will be ring fenced and spent on the NHS and social care healthcare services. So whilst HMRC and the Chancellor have said we're freezing, they're not quite, and we can see that increases in dividend rates and national insurance. The next increase in tax rates is for limited companies. I just want to flag this up because we're kind of leading into to one of the future presentations where we'll be looking at the optimum profit extraction method and whether it's still worthwhile being a sole trader, looking at the different levels of income and how best to extract income and structuring dental businesses. So for the last few years we've had the it's one of the lower rates around Europe, 19% across all corporate tax rates. So regardless of whether you're earning 50,000 or £1 million in your company, the tax rate has been a flat 19%. From the 1st of April 23, we've still got the 19% rate, but that's only if your profits are below £50,000. As soon as you start going above the 50,000, so between 50 and 250, there's a marginal rate for that slice of income, and that's 26.5%. And then over 250,000, it drops back down to 25%. So this goes back to the good old days where there was things called marginal relief, and one way that clever accountants tried to get around this was by setting up 3, 4, 5, lots and lots of different companies so they could have them all earning below the £50,000 mark. But HMRC were wise to this, and if you've got associated companies, those limits are reduced by the number of associated companies. One type of business that gets hit straight with the 25% rate is what's called a close investment holding company. So you may accidentally start getting taxed at 25% if, like many practice owners do, they'll have a property company which owns the property, and they'll have an operating company which runs the dental practice. If there's any rent charges going from one to the other, then potentially you've got 25% tax charge on the property company.
So, Bally, we find that most of our dentist clients that are working 10 sessions a week, so full time, I know some work a lot more and some less, but those completing 10 sessions a week generally are earning in excess of £100,000 a year or thereabouts. So they're going to be hit pretty hard with the limited company status. Now, we know through IR35, which we've completed a webinar in the past on, that this is going to have a big impact on a lot of dentists. Now, in your opinion, what are the easy, the quick fixes to actually reduce these tax liabilities moving forward from April 23?
So it's there's no magic wand that's going to it eliminates these tax liabilities. You'd be cutting your nose off to spite your face if you tried to reduce your top line income. You only want that, which would reduce your taxable profit. You don't want to unnecessarily increase your costs just so you can save tax. But it's all about planning. So, if you are planning to train some of the staff, or you're planning on laying out on some capex, etc. Those bringing forward expenditure that you might be expecting to make in the future periods. But certainly, if I've got an option of buying an X-ray machine on the 31st of March, I'd delay that until the 1st of April 2023, where I'm going to get a higher tax relief. So it's really just planning which periods things fall into. That's the main thing. But think that's one of the areas on, I think it's the next presentation, where we'll be looking at what this means for limited companies, and how best to mitigate corporate tax and how best to extract. So it may be that we start drawing our income out as salary rather than dividends.
Well, yeah, absolutely, and that opens a lot of other options as well. Absolutely,
yeah. So it kind of gives us a flavour of what's coming up around the corner, really. So that's kind of on the tax rate. Some of the other really significant changes that are coming up just around the corner are the way that sole traders are going to be taxed. Now, it's quite a complex area, but effectively from the 6th of April 2024, all sole traders are going to be taxed on a tax year basis, which runs from 6th of April through to 5th of April. Now, historically, if you've got a business with an accounting year end of April 21, that's the accounting period that would be used for the 21-22 tax year. So there's going to be some quite complex calculations to be done here, and again, quite a bit of planning. Whilst the tax year basis starts on the 6th of April 24, there's a transitional year which starts on the 6th of April 23, and again, now's the time to start planning for that. And I'll just flag up what this really means. So I've given you an example here. So Dr. D's got a year end of 30th of April. Normally, for the 2022-23 tax year, we'd take her accounts for the year ended 30th of April 22 and use those to prepare her tax return. 23-24, again, you'd expect to use the accounts for the year ended 30th of April 23, but again, that's the transitional year. So we've actually got to stretch out and look at the profits from the end of April 23 through to the 5th of April 24, and then make some fairly complicated calculations, which I'll touch on the next slide. And then 24-25, it gets onto the tax year basis. So just a little bit of an example here, and how things would work for Dr. D. So she's got profits of 90,000 in 30th of April 22. That's fine, nothing really doing there. 23-24, I've got the wrong dates on here, unfortunately. I've just spotted that. But assuming that the profits for 23 were 80,000, we take the period that falls into 5th of April 24 into account. You may or may not have, sorry, I've dropped onto the wrong slide there. You may or may not have a note of your overlap profit. And a lot of you won't know what overlap profit is, because it's an accounting tax nuance which occurred when you first set out in business, only if you didn't have a March or a 5th of April year end. So this may mean you having to go back and track back through your old records, and if you've changed accountants a few times whilst you've been in business, you may have to contact HMRC. But the overlap profit is real money for you, because it's going to reduce transitional profits, and it's that the transitional profit is one that gets spread over 5 years. Okay, so that's just something you need to plan for. You need to start sitting with your accountants and understanding what the impact of this transitional profit is going to be, because it will mean an extra slice of tax spread over 5 years, whilst we move from an accounting year-end basis to a tax year-end basis. Okay. So the things we've got to start doing right now is try and work out and talking to your accountants about what your overlap profits are, if you've got them. And if your accountant doesn't know, then we need to be getting onto HMRC and tracking back through their records to establish what those overlap profits are, because that's going to be money in your hands. Start looking at now. I mean, dental profits tend to be reasonably consistent. They don't fluctuate massively. So, start looking at doing some calculations with your accountant on what would be the impact if I changed my year end now rather than waiting a couple of years. So there's opportunities there. And also, if there are no opportunities on overlap relief or changing year ends, then you need to start thinking about, well, what extra am I going to have to budget for this additional tax on the transitional profits, because that's going to happen. And then there's also other factors where, sideways loss relief, if you've got losses elsewhere, and you're able to carry those back over 3 years. Again, it all interacts with the whole landscape that's changing over the next couple of years. And if that wasn't bad enough, from the 6th of April, we've got making tax digital for income tax, which starts. And effectively what that means is if you're a sole trader with a turnover of £10,000, which will probably be 99.5% of the dentists out there who are sole traders, or if you're just a landlord and you're only working part-time, and you've got rental income of over £10,000, you will need to prepare quarterly accounts and submit those online, and then following on from that, there'll be quarterly payments of tax coming through as well. So again, this is all the type of thing that we really need to be thinking about now, and then planning for when it really kicks in. And really, the name of the game is to make sure that your record keeping is bang up to date. It's you're using appropriate software to prepare your ongoing accounts, and making sure you've got systems and processes to be able to tackle making tax digital when it comes in. Okay, so I'm going to talk a little bit about investments, and these are some of the kind of tax-free ways of generating income and gains, etc. And hopefully you'll have heard of ISAs. If you're rolling up £20,000 a year in an ISA, and it's any dividends that come through will all be tax-free. Any gains within the ISA are all tax-free. You've got lifetime ISAs where you're allowed to put in up to £4,000 a year, and the government tops that up with an extra tax-free 25%. There's a restriction on cashing those out. I think, is that age 60 or something?
On lifetime ISAs, they've basically got to be used for either buying your first home to a maximum of £450,000, age 60, or terminally ill, which is less than 12 months to live.
So it's a great way of building up tax-free pot of cash, right? And there's not a lot of free money being handed out by the government at the moment. So
yeah, absolutely.
And enterprise investment schemes, there's these are businesses where you get tax relief if you invest into them. They tend to be privately owned, unquoted, but for every pound that you put in, you get 30 pence off your income tax bill. And if you sell the shares after 3 years, then any gains that you make are tax free. They do tend to be slightly higher risk, but there are some good tax incentives for the brave, I guess.
Well, the risk, I guess, is associated with the tax relief. The higher the tax relief, the higher the risk.
That's it.
Hence
the seed enterprise investment scheme, which is for really small businesses, and you get a much higher 50% income tax break, and you get if you've got a capital gain, say, on a property, and you roll the gains into a seed enterprise investment scheme company, then it knocks out 50% of your gains up to 100,000 off the top of my head.
Yeah. And do you know what the stats are for the failure rates?
No idea. Unfortunately, because these tend to be private companies, it's very difficult to
with the seeds. They're generally the younger startup so initial investments, and consequently they're probably the higher risk and the higher risk of failure. And moving through to things like, I know you're going to mention a little bit the VCTs, venture capital trusts, they tend to be more established because they have to be quoted companies. So consequently, the risks involved are slightly reduced, but the consequent benefits on tax relief are similarly reduced.
Yeah, and you still get 30% income tax relief on the VCTs, right? So
yes,
quite neat. And then I know a lot of my clients are dabbling, some more than others, in cryptocurrency, and this is an area that's been very, very grey over the last few years. And last year, HMRC brought out kind of a paper just to confirm exactly how they expected cryptocurrency to be reported. There's also some nudge letters coming out from HMRC saying, well, we're aware that you've got an account and you may have traded some cryptocurrency. I think some of the exchanges are the people like Coinbase are exchanging some data with HMRC. But effectively, the name of the game there is make sure you keep a detailed record of what you're buying and what you're selling. And it's not just selling for sterling or US dollars. You might be switching from Bitcoin to Ether to Cardano back into Ripple, or whenever there's a transaction, it needs to be recorded because it triggers a capital reportable event. So you do that over the tax year, and then look at whether there's a reportable gain to be made at the end of to be reported at the end of the tax year.
It can get quite complicated because some people use it as like traditional currency. So if they wanted to go into Microsoft and buy a laptop, you can actually do that with Bitcoin, as an example. And the problem is, if you do that, you need to keep a track of all of those transactions.
Yeah, absolutely. And it's a supremely complicated area. But again, it's all boils down to the record keeping. Okay, and then I guess we're just going to touch on a couple of cases. There was one which was concluded last year, and I think HMRC are probably going to appeal this one. I've come across a lot of dentists who have been using what's called a remuneration trust. and it almost sounds too good to be true, because this type of planning, as far as I'm aware, hasn't been registered with HMRC as a tax avoidance scheme. And in a nutshell, money goes out of the company, it ends up somewhere in Belize, and then it finds its way back to the owner of the dental practice. And Marlborough DP was a dental practice which used this scheme. HMRC tried to challenge it. They tried to, because a corporation tax relief had been claimed and no tax had been paid on the money that came out. It was almost too good to be true. But HMRC tried to deny that relief and tried to tax it as employment income with the associated kind of employers' national insurance. The case was decided. Effectively, what was decided was that the company wouldn't get corporation tax relief for the amounts that went into the Remuneration Trust, and the money that came out of the Remuneration Trust would be taxed as dividends rather than earnings. The taxpayer in that case basically ended up paying the corporation tax and the tax on the dividends. And I think HMRC is still looking at appealing that, because they want the national insurance on top. So watch this space.
So in your opinion on the Remuneration Trust, Bally, do you think that the people have gone down that road are going to be reasonably neutral, or do you feel that they will end up being a little bit worse off because of that particular case and the outcome?
In my opinion, people who have done the Remuneration Trust and gone through that planning, this case is saying that the corporation tax will need to be paid, and the money that's come out will need to be taxed as a dividend.
So the tax position will be the same, but the problem is those individuals that have gone into a Remuneration Trust will have paid fees to the trust administrator.
Right.
So they'll be basically getting nailed twice on fees, tax or fees to the trust.
That's it. And fees tend to have been paid on implementation. This was very similar to the Rangers case, where money that was taken out was taxed as what's called disguised remuneration. But they kind of differentiated the facts of the way these remuneration trusts are structured with the way Rangers. That was one of the leading cases. So they distinguished the facts and basically said, look, the money that's come out is effectively a dividend, so we'll tax it as a dividend, not as a tax-free loan, which doesn't get repaid, on which there's no tax. So that was a bit of a challenge. And there's another taxpayer, lived in Southampton and was training as a maxillofacial surgeon in London. And so that he wasn't having to commute every day, basically got himself a little flat in London where he stayed during the week, and then he'd probably come home at the weekends, unless he was on call, in which case he'd stay. Basically, he'd claimed all of his accommodation costs as an employment expense, and trying to claim expenses as an employment expense, it has to be wholly, exclusively, and necessarily in the performance of the duties of the employment. Which is quite a high bar, really, because it's very difficult to say that, well, I can't do my job unless I incur this expense. Whereas HMRC would say, well, no, the reason you've got this apartment is because you need a roof over your head. Basically, the outcome of that case was that he was allowed to claim for the time that he was on call, because he needed to get to patients within 30 minutes. And that was essentially it. It was time apportioned. Now, had he have been self-employed and or via a limited company doing a course away from home, then potentially the rules would have been slightly different, because we would have compared what's the cost of staying in a hotel versus the cost of staying in an apartment. So there's a degree of reasonableness applied to that situation, but because he was claiming these expenses against his employment income, it was slightly more difficult. Okay, well, look, I think we're doing for time 50 minutes, so that's really all that I was going to talk about this afternoon. I see the three of you are still awake.
Absolutely. Well, I enjoy it.
You do like these sort of things anyway, though, Richard. It must be said. It must be said. I'm surrounded by people with a love of numbers.
Well, it could be worse. We're surrounded by people with a love of teeth and gums.
This is true. This is very true. Yes. I feel your pain. I'm sure Julia definitely feels your pain. Okay, that was great. That was fantastic overview. I'd be very interested myself going forward into one of the next series of webinars, because I think I've kind of ticked virtually every box you've discussed there with my career, including limited company, sole trader, employed, self-employed. So yeah, it'd be interesting to look whether we're still making the right decisions for all the companies that I'm involved with. I'm not sure if we had any other questions in as yet, to be fair. If anybody's got any questions, put them in now. Or if there's anything specific that obviously you don't want to discuss on an open forum, then Bally and Julian and Richard are very happy for you to contact them directly and just to discuss it outside of this. Here we go. How are NHS pension contributions treated?
In what respect? So that's quite a.
That's a broad question, really. That's
it
a
is
topic in itself, really.
Yeah,
so.
there's different elements to NHS superannuation, isn't there? So
I think quite simply from the NHS contribution there, you get tax relief at source, so they're sort of deemed almost like an employee contribution to a pension taken through PAYE. And I suppose in simple terms, that's really the best way to sort of explain that. So you do get tax relief on the contribution, on your element of the contribution into pension scheme.
Yeah, I think that.
There's also the annual allowance and the lifetime allowances, which you need to keep an eye on, because those can trigger some nasty surprises.
Yeah.
Yeah, I think obviously going through the presentation today, Bally, and very informative in terms of the relevance to tax year end, and obviously you touched on some of the opportunities that are available to look to reduce liability going forward. I think part of this series is going to give the audience the opportunity to explore some of the areas that they can actually utilise themselves to try and look to reduce that sort of tax, and part of that is obviously through things like pension contributions, avoiding trip ups like the allowances, but also I think taking advantage of schemes and opportunities that are created by the government, and things like you mentioned the EISs, VCTs, seeds, and so on. These schemes are constantly evolving. So what's happening is, as they're evolving, opportunities do pop up. And for example, you mentioned things like social investment reliefs. So there's the opportunity to get reliefs for investing in social enterprises and charities now, which didn't happen before. And also in ISAs, there's innovative finance ISAs, which are basically now to include things like peer-to-peer lending, but also crowdfunding debentures, which is basically buying business debts. So there are all these different opportunities that are being created that really lend themselves to be able to reduce liabilities in a perhaps more creative way going forward.
Good.
Excellent, excellent. Thank you so much. So the next one of this series is going to be on the 17th of February, and that's where we're looking at in more personal tax, isn't it, Bally?
That's right. Yeah, we'll be doing some gymnastics now that we've kind of laid some of the foundations as to the different rates that we're going to be up against over the next few years. We'll do some gymnastics between.
Yeah, I mean, I
types of
wasn't
income.
fully aware of all those things that are coming in. It's not that long, is it? It's not that long.
No, it seems like a long way away, but you need to start thinking about it now and
Absolutely,
planning.
absolutely. Otherwise, we're going to get some nasty surprises. And then the one in March, that's where we're moving over to yourself, Julian, looking more at the personal planning element of things.
Yeah. I think what we're going to sort of try to do is within the February presentation is perhaps just touch on some of these areas, because what we want to do is if we do have clients that are interested in exploring some of these opportunities, then we really need to have that time to be able to put them in place before tax year end.
Absolutely.
So it might be a case that we'll sort of start to sort of tease some of these ideas out next presentation, so that we can actually deliver it by the March presentation.
Brilliant. Okay. Thank you so much. There's no other questions that's come in. Thank you, Richard. Thank you, Bally.
Pleasure. Thank you.
No, thanks, Rob.
Yeah, under the hour, that's good. Rest of my colleagues, we've got another webinar this evening looking at practice purchase with Abby Powell from CG Dent. We've got various people there talking about practice decisions, people who bought practices 20 odd years ago, people who've literally just bought practices a few years ago. And we've got Simon Hughes from Christian Co as well, helping with the facts and figures tonight. Next Thursday, we have the vaccination webinar. Nearly 4,000 registered for that one. So unless something dramatic happens with the government, I can't possibly see that. It's still looking like mandatory vaccination for healthcare workers is going to happen in England. So that is just to give people the information and support for that. Okay, thanks so much, everybody. Take